We're so far away. Here we go. Hey, and do not complain about my singing, because I just on Stephen Colbert yesterday, Peter Dinklage was singing. He's in Cyrano on Broadway, and that dude's got no voice, no voice. I'm not. I mean, not even the good talking while you're pretending to sing voice. He's like really got no voice at all. But he's playing Cyrano, so you don't have to have a voice. It's cool. I love him. I can't wait. I got to go see. I'm going to go to New York to see that play. But anyway, so don't complain about my voice, because that dude's on Broadway and he gets to sing. So where are we? I love that. I love that Cyrano story. I like that Steve Martin version was really good too, Roxanne. Let's see. Oh, wasn't it yesterday? How does time like fly so much? I know this must look very blurry to you guys. There's all the cool stuff. Look at the metaverse. That is cool. I like this chart. All the different metaverse companies are laid out for you. So if you ever get bored and you want to think about your investing premises, but Hewlett Packard, right? This is what I like. Apple Computer. You know, there's things like that. Coinbase, of course, we invested in. So, you know, we have our investments, but in things, and of course, we like Facebook. Facebook is better now, so that's a whole different thing. They're trying to take over this whole thing, basically. But, you know, you got to think about where you're putting your things and who's going to be in charge of this stuff in the future. Now, interestingly, in connectivity, they have Verizon, Ericsson, T-Mobile, blah, blah, blah. They do not have China, my buddies at China Mobile, who are not allowed to invest in anymore. They don't have AT&T. That's so obnoxious, right? But AT&T is pissed about that. This is sad. I'm sorry. This guy, you know, you got billions and billions of dollars, and this is what you spend your day doing. I'm sorry. I think real life. I think while we can still enjoy the planet, it's kind of like our obligation to do so. Why are we wasting it? I tell that to my kids. I tell my kids, like, I'm like, just enjoy long hot showers, because one day you will tell your grandchildren that you used to take long hot showers and then worry about the cost, and they're gonna go, ooh. You got to appreciate the stuff that we still have, because it's going. Now, I'm very upset now. This was yesterday was Tuesday. I swear I put out the things I did. Oh, there they are, son of a bitch. I knew it. All right, so let's talk about the bounces. We've got the Dow, and what we said was the zone around 35.2 and 35.250 is going to be critical and hard to break over. And so what happened? Okay, these are my comments from November 29th back here. And what happened? We got to 35.2, we failed. We went down again yesterday, had a bad day yesterday. We came back up a little bit, but what's the problem? We're losing ground. And that's why when you see like this morning's action, you have to keep it in context and be like, no. This only looks exciting because we were way the frick down to 34.4 and we come back to 34.8, 35, whatever. It doesn't matter. Because in the you know, you can't let yourself be fooled by short-term action. The long-term action is on the grade of fall. We were looking for a bounce to 35.2 and 35.250, and we didn't make it back. That's very bad. This is this is getting worse. This isn't getting better. And that's the problem now. In the S&P, I said we'll call it a 25-point bounce to 46.25, and 46.50 is strong. So what happened? This was, and again, these were my calls from Monday. So Monday, we got up to the 46.50, but we ultimately got rejected there. Then we come way down, make new lows. Now coming back again, 46.50. Now it's harshly rejected, the strong bounce. And now when you get below 46.25, you're failing the weak bounce. It's very bad. That's why we have these numbers. Whoa, I didn't do that. Well, I did do that, obviously. I didn't mean to do that. You know, that's what these numbers are for, is to tell you where, you know, what you should be getting excited about and what you shouldn't. Now look at the NASDAQ. And notice how these firm up, because when you're first bouncing, things are going to be more bouncy. But when you try on the second bounce, that's when you're really going to see the 5% rule kick in, because you usually don't have quite the easy time getting back over these levels. So, you know, once you fail, you got big problems, because it's very hard. It's much harder the second time to get out of the pattern. But again, that's how it works, though. In other words, if you have a sharp V correction, you generally can get a nice quick recovery, right? But if you have a weak V correction that goes out over a longer period of time, you're going to have more trouble retaining your highs. That's the 5% rule shows you that, basically. It's saying if you can't do this, then this is going to happen. It's going to turn ugly. So here I said we'll look for a 100-point bounce to 16.3. And that was on Monday morning. We just talked about that. So we hit 16.3 was a weak bounce. 16.4 was a strong bounce. But we really look how the NASDAQ obeyed 16.4 at the end. Flatline 16.4 goes down, comes back, goes back to 16.3. Another attempt at 16.4 rejected. Way back down, it's trying to gather its strength to get back up. It comes way back down, takes another run, and again rejected at 16.4. 16.4 is looking bad. And don't forget, 16.4 is the strong bounce line. So there's 300 more points above that the NASDAQ would have to go to get back to its back to where it was. But we can't even get past 16.4. Now, when you fail it once and you fail it twice and you get back below the weak bounce line at 16.3, if we finish today below 16.3, we are almost certainly going to be consolidating for a move lower. And 16, so the move lower below 16.2. And then you're going to be looking at the next 2.5% from there. And on the Russell, you're looking at we set a call at 2150, blah blah blah, bounces to 2200 and 2250. What? 2200? How low were we? That doesn't make any sense. 2150. So, huh? Okay, I see. Let's look. Luckily, I put the larger context in here, because I'm like, I don't remember what I said there. 2400 was the top. I'm making a judgment call. Oh, I see. I'm making a judgment call that we're in a 10% correction, 2160. So we did the math. We did the math here, and here's where I did this in. Here's 2160. Even though we never got to 2160, and I said this Monday morning, even though we never got to 2160, that was a 10% correction from the top. And I said, I believe we're heading for a 10% correction. Therefore, if we're heading for a 10% correction, even though we never got this low in the first place, I said the math would be that we'd get 2150 would be a 50-point bounce off the 2160 line. I'm sorry, we'll call it, I'm sorry. I said we'll call the line 2150 just to round it out. So a 50-point weak bounce from 2400. So 2400 to 2150 would be a, no, I'm sorry, it wouldn't be 50 points, 500, no, 250. Yeah, it's a 250-point drop from 2400. So therefore, you would have a 50-point bounce. And the 50-point bounce from not from where we are, but 50-point bounce from 2150. Wow, no wonder this is hard to explain to people. I'm thinking like I'm confused. In other words, once you see a correction, let's look at the bigger picture. It's not as complicated as it seems, but it's a question of like doing it in order. So we're throwing out 5% rule is very big on throwing out irrelevant data points. This is an irrelevant data point. What matters is this on the weekly chart, whatever. You don't spend more than a week above 2400. We stopped at 2400 before. We know 2400 is significant. 1600 was significant and 800 was significant on the Russell. So in other words, the Russell moves 8, 16, 24. It moves in 8s. So 2400 and then a 10% drop from 2400 is where we calculated the fall. And that's what I said. And I said, so we're going to get a 10% correction from 2,400, which brings us down to 2160. 2400 times 0.9, 2160. Yeah. So so we're going to fall to 2160, and you can see 2160 has been a thing all the way around here, right? That's been a pretty see if we can get exact. There's a line of 2160 all the way across. So you can see that 2160 has been a serious line for the entire year, basically, as a low end support. So we're predicting, or we predicted on Monday that we retest 2160. And so I said, I'm assuming that's what this was about. So in context, what I was saying was, what did I do with it? Was this Monday? No, yesterday. God damn it. You know, the problem is you can't see it, but there's a whole bar over here for the webinar running bar. It's over there. It can't have been all the way down there. There they are. Okay. So what I said on Monday was, all right, so 2,400 was the top, and I'm making a judgment call that we're in a 10% correction to 2,160. So, okay, let's start with that. And I'm making a judgment call. So 2,400 was the top, and I'm making a judgment call that we're in a 10% correction to 2,160. That's what I'm talking about when we said that. So I'm sorry it took a long way to get to it to make sense. So that's 240 points down. I said, so we'll call it 2,150 because the market loves the more significant lines. And a 50-point bounce would be to 2,200 and 2,250. So if my theory is right, 2,250 should fail, and we'll fail 2,200 on the way back to 2,150. And if that happens, then the correction isn't over for the others, and we'll expect retests of their 2.5% line. So that's basically what kind of happened yesterday. And it's happening again today. And I think on the whole, we're looking like we're going to fail and fall. No, not you. You. So I was making those comments here, and I said 2,250 was the line to watch. And if we fail that, we're going to retest 2,200 on the way to 2,160. We haven't hit 2,160 yet, but look what happened. We failed 2,250 again. Now, again, it's the same story, right? See, and you notice that even though the indexes are at very, very different levels, they're all doing the same thing following the 5% rule. They're all failing their strong bounces, and they're coming down. And in this case, this is even the weak bounce for the Russell. So it is not looking good. It is most likely we're going to fail 2,200 again, and we're going to head right down to 2,150, and we're going to eventually fail that probably in the very near future. So unless something really good happens for the markets, we are in a beginning of a downtrend. This is only the very beginning of a downturn. So batten down the hatches, et cetera, et cetera. Snooze, pick a time. You know, I pick a time and it never does it. Pick a time. 5 p.m. Go for it. Whatever. Okay. Now, where were we? Let's see if we have any questions first. No questions. All right, fantastic. That's what we like to see. Everybody's happy. Ooh, ooh, ooh. That's getting ugly. Okay, well, you know, like I said, not good. So let's see what else is happening. Futures. Okay, so let's look at everybody. So it's just generally weakening, and this line is your critical line. If this fails, and that's what I was talking about. In fact, I planned on talking about it today. Oh, why? Here's the thing, why? And that's another thing they're going to ask me tonight. I'm on Money Talk tonight on the show. So They had so many questions for me. I'm the only guest on the whole show. I'm going to be in all three segments. So one of the questions they had me, they're saying like, why are you watching the Russell so closely? And I said, well, the small caps are more indicative of what's actually going on in the economy, because the tech companies in the NASDAQ, they're not in the real world. They're not like participating in your daily life. You need Windows to live. You can't run your computer without Windows. You're going to pay Microsoft their $100 a month fee or whatever the hell they charge for these things, $10 a month. You're going to pay Microsoft. You're going to pay Google. You're going to pay Netflix. These companies don't live in reality. They're not affected by your day-to-day life, and so they're not going to be an indicator of the economy turning down particularly. The S&P 500 and the Dow, of course, the big cap companies do half their business, getting towards 60% of their business overseas. So they're only somewhat affected by the American markets. They're not going to give you a real good indication of what's happening in the U.S. economy. Whereas the Russell 2000 are the smaller companies, 2,000 of them. They're not dominated. That's the other problem with the S&P. The S&P is just as much an Apple index as the NASDAQ is. And Apple was up 3% yesterday, fighting everybody. Today. Oh, no way. And today they're up 2%. This is insane. So look at Apple in the last couple of days. They've gone from under 160 to 168. And is that 5%? What would 5% of 160 be? Be 8 points, right? There you go. So it's 5%. So Apple has now hit the 5% rule, going from 160 to 168 in 2 days, while the rest of the market is selling off. And why is that happening? That happens because these indexes, all three of these indexes are very Apple heavy indexes. And all three of these indexes look better than they are because Apple is up 5%. Apple is 20% of the NASDAQ. So 1% of the NASDAQ, 162 NASDAQ points. No, I'm sorry, Apple's getting close to 20% of the NASDAQ again. But anyway, so a couple of hundred NASDAQ points are caused by Apple going up. The entire rest of the index can be going down and Apple's going up, and it makes it look like it's not as bad as it is. People manipulate Apple all the time to do this, to cover the sell-off. They manipulate Apple and they manipulate the dollar. Those are two things that get manipulated to cover up a sell-off. So you can't trust these readings. Now, Apple's not in the Russell, very helpful. No single stock dominates the Russell there. Almost any stock in the Russell is less than 1% of the index. So there's no real way to get a few, you can't just buy 10 stocks and move the whole index like you can with every other index can be moved by just manipulating, basically by just manipulating Apple. But if you take 5 stocks and manipulate them in the NASDAQ, S&P, and Dow, you can make it do tricks and roll over and do whatever you want. The Russell is harder to control. So when you see the Russell selling off 10%, that's probably what's really going on. And especially that's what's really going on in the U.S. equity market. These are lagging indicators and fake indicators, so you really can't go by that. And and eventually, and again, I used to use in 2008. I had to do this a lot because it was hard to, because you would see these really weird things happening, and this was why. But I call it a tugboat model, and the tugboat model means, like, if you ever look at tugboats. Let's say there's like 4 tugboats pulling a barge, right? And the tugboats all have a rope. And the tugboats all generally try to pull in the same direction, right? But what's going to happen is if 3 tugboats go one way and 1 tugboat goes the other way, the other tugboat is only going to get as far as its rope tightens up, and then it's going to get pulled back with the rest of them. They all have to work together to move the barge. So if you think of like the S&P being a barge and these guys are tugboats, then they're going to move the S&P. Now, if these guys are moving the S&P a little bit down, 2.5% down, but the Russell is running out 10% down, where is it going to snap? Well, the 5% rule tells us that it's going to snap at the 10% line. So either the Russell is going to snap back up, or these guys are going to snap and move along with the Russell. And that you don't know until you see it happening. But so in other words, you're going to see these guys hit their 2.5% lines at the same time you see the Russell hit the 10% line. But what happens next is something's got to give. At this stage, something's got to give. You know, obviously the S&P is now, because 2.5%, 2.5%, 2.5%. These guys are all moving 2.5% down. He's pulling harder down. The Russell is pulling us down harder. All right. Now, what do we know, though? We know that the only reason the rest of them aren't down more than 2.5% is because of one frickin' stock. It's because Apple's up 5%. And we know that there's no particular reason Apple is up 5%. Nothing happened in the last couple of days. To some extent, it's a safety stock, but realistically, it's being manipulated higher to take your attention away from the fact that everything else is selling off. Market is weaker than it looks. That's the bottom line. So that's what you got to be on the lookout for here. Energy, obviously, if you know, look at oil, look at gasoline. You know, we knew it was all bullshit when it was up anyway, but now it's like unwinding really fast. And this is not all because of Omicron, because realistically, there's no net effect yet. Nothing's been, you know, there haven't been widespread shutdowns. There are some shutdowns, and people are starting to realize like all this stuff can happen again. Look at that. That's weird, huh? People are realizing it can happen again, but you know, on the whole, what we're doing is we're unwinding a fantasy. This was all a fantasy of demand being X and this and that, and you guys know that. I was bitching like crazy about this the whole time. I was saying this is just bullshit numbers. This doesn't make any sense. And the only reason there's any shortage of oil is because OPEC refused to pump it. And what did Joe Biden do? Joe Biden released the 50 million gallons. Now we have, oh, here you go. Weekly petroleum. We have in the Strategic Petroleum Reserve 604 million barrels of oil, and Joe Biden is going to release less than 10% of it, 50 million barrels. Just announcing he's going to release 50 million barrels freaked everybody out in the oil patch. And so they have to unwind their position. That's what you're seeing happening here, is they've been unwinding the crap out of these positions. Because it's not, and by the way, some you know, one of those conservative news assholes asked Joe Biden, not Joe Biden, they asked his energy secretary, and she didn't know the answer, so her fault. But it's like, why am I not the energy secretary? Because they asked her, what good is releasing 50 million barrels? Do you know how much money? Oh, do you know how many barrels the U.S. uses per day? She didn't know that. I was scary though. I didn't like that. She doesn't know how many barrels of oil the U.S. consumes every day, which of course you know is what? It's 18 million barrels a day. Anyway, so they said, what good is that? Now, there's two parts to that question, because first of all, you have to know the number is 18 million barrels a day, and we know that because we pay attention to our EIA reports. Oh, look, it's 20 now. Yeah, see, I'm wrong. So it's 20 million. No, it's not really 20, because we're shipping. See, this, I would maybe not be a good energy secretary because I would feel obligated to explain this. Okay, yeah, we're using 20 million barrels. We're producing 20 million barrels worth of product, but we're shipping 3.3 million barrels out of the country. That is not using. So we're back to my 16 million number, right? Yes, we are. That is not using. The U.S. is not using this oil. We are refining this oil for other countries, and we are selling product to other countries. That's not using. Our consumption, what we actually need to use, is or let's say 17 million right now. So if you do the math, about 17 million. Anyway, so, and it's not about that we use 16 million a day and it's only going to cover 3 days. 50 million barrels only covers 3 days. That's not the point. The point is the marginal amount of oil and how much oil actually comes in from OPEC to the U.S. Less than 2 million barrels a day. So less than 2 million barrels a day of our supply comes from OPEC. So if you ask me what the difference 50 million barrels make, it means they can shove their oil up their asses for a month is what it means. So that's what it means. So unless they're going to cut all of their oil to us for 1 month, it's going to create a glut of oil from OPEC that we do not need. And it's the marginal cost of oil that has the effect, not the total thing. You don't look at it and say, well, we consumed a trillion barrels this year and you took out 50 million barrels, so it's a drop in the bucket. That's not how it works. Okay? In other words, if I fill my pool, if I have a 100,000 gallon pool and I fill it with 100,000 gallons of water, that's going to fill it to the top. Now, if I put 10,000 more gallons in, my whole house and my yard floods because that was way too much water. The fact that 10,000 gallons is 10% of my pool isn't the point. It's the marginal increase that I've caused. It was not necessary and therefore causes a glut of water all over my yard. Same thing with oil. The marginal increase causes a glut of oil and floods the market with oil that nobody wants and drops the price. So if I were the energy secretary, there would have been very different headlines when that question came out. So that's because of that, the oil didn't go down right away because they said, well, what good is it going to do? You know, it's funny when you see the media, you know, which of course is, you know, Russian bots and so on and so forth. But it's funny when you see how the media blows up certain stories and makes a mountain out of a molehill to count, you know, to push forward somebody's agenda. And the agenda they wanted was to keep the oil prices high despite Biden releasing 50 million barrels. So one of these reporters is told to ask a question. Now, how is a reporter told to ask a question? Well, reporters call me all the time and they ask me questions and then I give them answers and then I see my answers in print. So in other words, a reporter asks me, I'm one of their sources, and they will ask me a question about this or that, and I will say to them sometimes, I will say, hey, did you check this out? Do you realize that if you look at this and this and this, that you'll find that? And all of a sudden you see them start digging into some side of a story because I brought it up and they saw it was happening. Well, there's a lot of reporters who are really lazy and just print whatever the hell their sources say. In fact, I'd say probably the vast majority of them do that. They have a source and the source says something to them, that's what they print. So just like in a spy movie, I mean, these people develop, these operatives of the oil companies and whoever, they develop relationships with reporters. They become trusted sources, and these guys are in the industry somehow and placed around. And they get the ear of a reporter. And then when something comes out like this, like Biden's releasing the SPR, they'll say to their reporter, they'll talk to their reporter and say, oh, this is nothing because you don't realize the SPR and it's only a drop in the bucket, blah, blah, blah. So they start spinning the story to be that 50 million barrels is nothing and how is this going to make an impact and blah, blah, blah. When a real oil economist is going to tell you it's a huge impact. It's gigantic. That's why we only have a 600 million barrel strategic petroleum reserve. We could have a trillion barrel strategic petroleum reserve, but we don't really need it because unlike most countries, we have massive private reserves. Most countries don't have giant private reserves. We have private reserves of crude 600, I'm sorry, that's the SPR 600 million. Other oil in storage, 400 million. Gasoline storage, 200 million. Distillates, 120 million, 450. So we have 1.8 billion barrels of fuel in storage compared to not really 20 million barrels a day that we're using. So how many days is that? It's 90 days. So we have a 3-month supply where we could have absolutely no oil at all and we'd still be fine. Now, in reality though, half of the oil that is produced that we're using is in America. So 10 million, 11 million barrels a day of oil is produced in the United States. Well, the United States isn't going to cut off the United States. So we have 11 million barrels domestically. Now we're talking about 9 million barrels worth of imports. Who do we import from? We import 4 million barrels from Canada and 3 million barrels from Mexico. That's 7 million barrels that we import. So there's only 2 million other barrels coming in, mostly from OPEC. So since we're not going to go to war with Canada and we're not going to go to war with Mexico, and neither one of them are going to cut us off, and you can't blockade the pipelines, you know, unless you invade the US, Canada, and Mexico, you can't blockade the pipelines. We're going to keep getting oil from those places. They've got nowhere else to sell it. They don't have an option. That oil is set to be delivered via pipeline to the United States. That's the whole point of pumping it. They can't change their mind and put it on ships. They don't have the facilities for it. It would take them years to find a new customer. You know, we have an extremely tight NAFTA, whatever you call it, trade agreement with Canada and Mexico, where over the last, well, when the hell was that with Ross Perot? That was the 80s. So over 40 something years, we've developed an infrastructure where our three countries work together on a lot of stuff, and to the point where Mexico's oil industry is there to supply mainly the US. Canada's oil industry is there to supply mainly the US. So we're not going to get cut off from oil. So in reality, this 1.8 billion barrels is really the marginal supply against 2 million barrels of imports per day. That means we have a 900-day supply, 3 years. So if OPEC wanted to cut us off completely, we'd be fine draining our reserves for 3 years. Not fine, obviously, you don't want to drain your reserves like that. But it would, you know, for 3 years. So believe me, in 3 years we'll drill some more local wells. And that's what keeps us, that size SPR keeps things in check. If we wanted to, we could double the size of the SPR, but there's no need. We hardly ever use it for anything. Even in a crisis, we don't use it. It would be fun to, if I were president, I would double the size of the SPR and use it as a weapon on a regular basis and keep these jackasses in line. And I would tell OPEC, the most you're going to charge for oil is $60. Otherwise, I'm going to wreck your lives. All right, let's see. I want to finish this up first. What were we talking about? Anybody remember? The Russell, the U.S. economy. Yes, all right, I think we were done with that. Let me look on there. All right. So you don't see any kind of recovery at all in energy. So what are these guys excited about if the energy market says things are falling to shit? Bonds, short-term bonds, look at that. Look at the 2-year collapsing, right? So the rates that means rates are going up. The value of a bond, here's what this means. This is very important to understand. When you see the 10-year note, this is the average value of a 10-year note. So of the last 10 years worth of notes, the average value is 130, basically. So that's fine. Now, why does it go up and down? If the current notes are of a lower rate than the 10-year average, then the higher rate average notes become more valuable. If the current notes are at a higher interest rate, then the older notes become less valuable because people would rather buy the higher rate new mortgage, the new 10 years, than they would buy the older ones, which have a lower interest rate. That's why it gets confusing to talk about it, but that's basically what causes the effect. Now, commodities. What are we looking for? We're looking for a sign of strength in the economy, right? We're looking for why are we recovering? What would we be bouncing about? Well, cocoa's down, cotton's back down. Cotton was out of control, though. Cotton's crazy. Here, wait, let's look at a longer cotton chart. Look at cotton over the last, basically, well, from 2020. But let's say, you know, normally cotton 70 is normal. It went almost to it went to 120 this year. So now we're calming down a little bit, but still way, you know, 50% higher than usual for cotton. Orange is calming back down. Coffee's pretty high right now because of weather conditions, problems, drought, so on and so forth. Sugar's falling back down. Sugar went crazy also. Lumber is back up again. Lumber has had a hell of a ride, right? Lumber was way up, way down. I mean, this is crazy. Here's 500, 1600, 400. So what's a tree worth? Who the hell knows? I mean, this is just not even rational pricing. And this is after years of 400, 600, you know, four to six, you know, you plant a tree, you're going to get 4 to 6. You're pretty sure about that, right? And all of a sudden, now we're like, what the hell? Where are these numbers coming from? So lumber went completely insane. You know, and lumber's Partly it's a shipping issue, you know, where the ships are backed up and it's hard to move things back and forth, and the shipping costs have gone up, and lumber is obviously a very bulky item to ship, and not just on ships, I mean on trains too and things like that. So there's external factors. It's certainly not because we're building houses like crazy or anything. So it's a little bit weird. Gold having a hell of a ride over here. Silver is in the down phase. At 22, I start liking silver long, in fact. And gold at 1752 is also a good spot to hold. Copper down, you know, and again, these are not strong signs. None of these things are giving us any real strength. Who cares what cattle does? Who cares what grains do? You know, they are what they are. They're just weird things. And currencies, how's our dollar doing? So the dollar peaked out at 97. It's pulled back to 96. So the dollar's down 1% in the last week, also giving you the illusion the market is stronger than it is when the dollar's down 1%, because it's almost a 2-to-1. So the market down 1% would boost the market 2%. So there's a lot of things between Apple and the dollar. The market looks way stronger than it really is. So we're gonna have to be very careful about this stuff. All right, so now I can get to a question. And Brendan says, what do you think is going on with AT&T and Viacom? They've both been down in a straight line. Yeah. Well, Viacom is like the wonder of the world. In fact, I just reiterated it as a trade today and sent out a top trade alert. This is madness. All right, $30, $31 for Viacom is $20 billion valuation. Okay, and they make $2.5 billion a year. So they're not even trading at 10 times earnings. And if you look, the top line revenue in 2017, they made 26, 2.3 billion dropped to the bottom line. 2018, 26, 3.5 billion. Why? They were expanding and they started and they spent money, and then the spending wound down, and now they're reaping the benefits. 2019, 3.3 billion. 2020, well, bad stuff happened in 2020, so the revenues went down. But I'm sorry, not the revenues, the profits went down. But the revenues are still pretty strong, and now they're skipping back as if they were uninterrupted, and they're back to 29.5. Now, if they normalize and get back to where they were here at 29.5, they should be making $3.5 billion or more. So these aren't even their best revenues, and they don't have a lot of debt. They've got excellent properties. This is CVS, right? So they've got excellent properties. They just sold, they just today or yesterday sold Studio City in California for $1.8 billion. They were expected to get $1.3 billion. So this $500 million bonus dollars are going to get added to their bottom line in 2021. So it's going to be this number is going to be $3 billion. And you can buy the whole thing for $20 billion. It's insane. So, you know, to answer your question on Viacom especially, you know, what do you think is going on with AT&T and Viacom? People are idiots. I mean, there's no logic to this at all. This is a super solid, fantastic company with, you know, one of the major television networks in the United States. They own Paramount. They own Comedy Central. They own all the Star Trek franchises. They own MTV, which is I think probably the single most known thing in the world as far as television networks is MTV. This is just ludicrous. There's no logical reason for what's going on here. I mean, the company is just doing what it always does, and they're not really changing it. So, I mean, there's nothing for it. Now, AT&T, on the other hand, you know, they've been misfiring a lot. But still, again, it's the freaking phone company. They've got half of the people in the United States use AT&T. And look at these numbers. And again, here, it's the same kind of thing, though. It's the same ridiculous thing. $163 billion company. They make $23 billion a year. They made $30 billion in 2017, 20 billion here. 2019 was not a good year, but they were rolling, you know why? Because they were rolling out 5G. It's expensive to roll out the next generation of things, but this is what they call a cyclical company. A cyclical company means sometimes they have to spend a lot of money to make the next round of money because they're an infrastructure company. They have to build their infrastructure to do these things. So AT&T was in the middle of doing their 5G rollout in 2019. Unfortunately, in 2020, people didn't begin switching over to 5G like they were hoping because everybody was inside. Nobody needs to go 5 miles from their Wi-Fi spots. So this stuff didn't catch on like they hoped. They had a down year with $5 billion in losses, but now they came back this year quite nicely with $23 billion in profit. Next year, they should make $23 billion in profit, and they'll start making 25, 30, whatever billion dollars. Now, if people want to ignore, now, they spent a lot of money. That's why the bankruptcy risk is here. They spent a lot of money and they've got a lot of debt, but it's a freaking phone company. That's what they do. It's their job. This is what cyclical companies do. And people don't understand how cyclical companies work anymore. Because I don't like to call them investors. I like to call them traders. To me, anybody who thinks this way is a trader, not an investor. I mean, modern traders don't invest in anything for the long run. They want to know what the quarter was, how's this quarter, how's the next quarter. They don't give a crap about what the future looks like. Unless it's a tech company making no money, then they think it's the greatest investment in the world, or losing money. If you're losing money, they think it's going to be great in the future. But if you're making money, they say, oh, well, that's not enough. It's just ridiculous. So I don't know. I mean, it's a cyclical company. Some years they're going to do well, some years they won't do well. You look at the earnings, say that's erratic. Earnings should only go up. It doesn't work that way. It works that way for Facebook, or it works that way for Netflix, because all they do is put a bunch of servers on the wall, and then they sell their services, and the more people that buy their services, their costs don't really increase. They wrote the program already. They wrote the program, they built the servers, now they just need the people. And any additional costs that they incur from adding new people is incremental and is added as the people are added, so they always seem great. Okay, AT&T can't do that. AT&T needs to cover the country with 5G networks to get people to buy 5G phones. So first they have to cover the country with the 5G network, then they have to sell you the phones. So they have to say, if we build it, they will come. That's what cyclical companies are. They're a field of dreams. If you build it, they will come. But they're not idiots. These companies, I mean, obviously some companies build things, nobody comes, but that's not the situation for the phone company. They know how this works. Another factor, it's another funny thing. Another thing about AT&T is the bandwidth auctions, because they always have to buy bandwidth at auction. The bandwidth auctions got more expensive. They jumped up in price. But that's not harmful to AT&T. That's harmful to people who can't afford to buy the bandwidth. Yeah, they spent a couple of billion more dollars than they thought they would buying bandwidth. Okay, that's a couple of billion out of this is nothing, but the point is they won the bandwidth auction. Okay, the companies that couldn't afford the bandwidth because it got too expensive at auction, those are the ones that are screwed. They're competitors. Small regional carriers and people like that are the ones that are screwed. They're going to be less of a threat to AT&T. Therefore, down the road, AT&T will spend less money having to market against them. AT&T will have less pricing pressure coming from competitors. AT&T is the one winning. AT&T is the one who they're the ones bidding at the auction. They're not victims of the auction. They're the leading bidder of the auction. It's just too funny. I mean, people just don't understand how things work. That's what the problem is. But that's ridiculously cheap. Anyway, all right, I can't talk much longer because I can't afford to not be able to talk later. Where was I? PhilStockWorld. There you go. So money to our portfolio. Let's talk about that because that's what we did today. And that's what I will be talking about tonight on the show. So last time we did the money talk portfolio review, we cut it down. We cut a couple of positions over the summer anyway, and it was pretty small. Well, where is it? Our last review on August 31st. There you go. All right, so the money to our portfolio on August 31st had gotten down to this. We only had 1, 2, 3, 4, 5, 6 positions in the money to our portfolio at that time because we had cut a lot of our, we cut a lot of our winning positions I didn't want to get into. And again, why? Because I wasn't sure that when the market would dip. And I said, I think the market's going to dip at some time in the next quarter. As it is, on the nose right now, by the time I was next on the show, I knew we'd be on the show again around Thanksgiving. So I had a time frame between August 31st and Thanksgiving. So September, October, November, exactly 3 months, basically. So over the next 3 months, I had to say to myself, what do I feel is going to happen in the next 3 months? And I felt that the market was going to take a dip. Therefore, we didn't do much that wasn't defensive. But what we did was we added some gold. We changed our gold position. We cashed out IBM. We left Pfizer on because it was so in the money, it didn't matter. SKT we cashed out because it was also so in the money, it was pointless. And that was August 31st. That was at 17, it was already like super in the money for us. Now it's like 19, 20. And SunPower, we had no fear, so we didn't worry about that one. And here's Viacom, which we left on, and now today we've actually pushed it a little bit. So I said, look, it's net. We were in the $30,000 spread. We spent $4,600 on, and it's net 9,000. So we were still profitable enough where we weren't thinking we were going to lose anything. So we left it on, and it actually got worse, surprisingly. And again, that was a decision from August 31st at 40, and it's gone down to 30, but we didn't take too much damage on the whole. Then we added Hewlett Packard because on August 31st, I thought it was stupidly cheap. It was $30, and it actually went lower before it went higher, but it was stupidly cheap. And Boyd Gaming, I like them because I think sports betting is a big story for next year. And what do we say? This is August 31st here, so it's still at the same place. Basically, it's still the same trade. So it went down, then it looked like it was going to take off on us, and that's why I wanted to get in. I was worried it would take off and not come back, but then they had a big pullback, and now they're back to where we were. Still love this as a new trade. So that brings us back to where we are today with the money to our portfolio, and it's the same portfolio. Here's Boyd, and here's Hewlett Packard, and we had ditched the other two. So we have 1, 2, 3, 4, 5, 6 again. So we still have 6 positions. All right, so looking at these positions, and the key is that we have $167,000 in cash. So there's only $32,000 worth of actual things. Now that's net cash. Of course, there's certainly obligations to buy things with the puts, but the bottom line is that the cash on hand is severe. So we have plenty of room to play and plenty of room to cushion ourselves if we have to. And each time I have to look forward and think, what's the next 3 months going to look like? I do think we are going to have a dip in the next couple of months, but I also think we're going to recover into the spring. So I'm not too worried about this right now. I don't think we're going to have a permanent dip right now. I think that the Fed and the government has one more round of stimulus in them. So this is not the last dance for this market. I do expect a correction, but then I expect a recovery. But the next time after this, I'm going to be a lot more worried. So I talked about Boyd. It's cheaper than where we started, and it's great for a new trade. And when I say cheaper than where we started, if you look at it, it's minus 53 plus 41, minus 10 plus 15. It's really the same as where we started, but you get the idea. And what saved the Boyd trade? What saved the Boyd trade was we sold $1,850. We made a one quarter sell of the 70 calls. All right, so keep in mind this was the end of September, right? No, I'm sorry, it's the end of August. So that's not Boyd. So at the end of August, we were at, wait. Was it the end of August? It was August 31st, yeah. So at the end of August, Boyd was at like $63 or something like that, and we sold the 70 calls. Where are they? We sold the 70 calls for $370. It was a crazy price. Why? Because it had been shooting up. All right, so the volatility of the 70 calls was high because it looked like it was going to hit that, and that's what happens. Is there's a lot, and you have to be aware of that when you're doing options. Okay, when you see something flying down, good time to sell puts. When you see something flying up, good time to sell calls, because people start jumping on these out of the money calls, thinking that there's always people who think that if they see a pattern, it's going to continue forever, and they think, well, by then it'll be at like $85 at least. People don't understand that there's limits to these things. Anywho, so that's what saved that, and that was our plan though, because when we went into Boyd, I said the reason I really like this trade is, aside from the fact I think Boyd's going to take off, while we're waiting, we get to make these sales. We sell $18.50 a quarter. That's great. Now, in this case, so what did I decide? I decided that we're not going to make a sale here because it dropped a lot, almost. I mean, not from where we were, but it dropped back, $7, 10% back from where it was. And I think this is too low, and therefore I'd rather not make a sale now. And I'm hoping next quarter we catch it, more like 65, 70 again, and we can make a sale. You don't have to sell every time. You got to make a judgment call every time to decide whether it's worth selling. I don't want to sell the 65 calls. I think we might go over 65, so I'm too bullish to make a sale of a short call right now. But 70, I thought was a stupidly high price, so I didn't mind selling it. Then gold, I talked about gold, and we leave that one alone. We still like it where it is. Hewlett Packard, of course, has already popped up. It's not, it's already past our goal, so we're like done with that one. Just waiting to collect our money. But meanwhile, it's only net $79.20 on a $20,000 spread, even though we're totally in the money. There's $12,000 of upside on a $7,200 play, and all Hewlett Packard has to do is hold 35, and I think that's a this year play. So yeah, it's a 2023 play. So for 1 year, you can make all that money from this spread. That's crazy. I mean, these options plays are like free money sometimes. It's just unbelievable. Pfizer, again. Pfizer is now so much in the money, it's not worth keeping, so we're cashing that out. SunPower. The problem with SunPower is it's too in the money to bother with. So despite being 100% in the money, there's still 7,000 a gain, but we know we can do better. So what I'm doing is I'm rolling the SunPower. We're taking the calls that are so in the money, which were the $15 calls on SunPower, because SunPower is up at 28. So we're taking the $15 calls, and we have 15 of those, and we're moving to 35 longs, 35 $25 calls. Now, we went up from 15 to 25, but we bought ourselves another year, the 202 425s. We've taken the, we're selling 25, so we're covering 35 with 25, 2024 $35 calls. So we're giving ourselves, now we've removed our target to 35, gone from 15 to 35 longs. We sold 25, 35 calls, so we're not very worried about that. And now these short, the remaining short 15, 2023, $25 calls are now our shorts that are short-term, are now short-term shorts relatively, covering the position, and we're also selling some more puts. So we have the spread, we have it covered by the short-term calls, by the shorter-term calls, and we've got the puts, and it goes back to the same thing. So we've turned this from a play where we hoped to make $20,000. We cashed $10,000 out. We've taken $10,000 out of our pocket with these changes, but we've left ourselves with a $35,000 spread. So instead of taking 20, well, it's only net 79.22. So instead of taking 79.22 off the table, obviously we don't want to do that. We took 10,000 off the table, and we left ourselves with a much bigger spread. So there's nothing detrimental here at all. We had a $15,000 potential. We could have made $7,000 more on this spread, but instead we cashed out $10,000 into it, put it in our pockets, and we moved ourselves to a $35,000 spread. In what way is this bad? Can we still make $8,000? Yeah, obviously we can still make $8,000. We can make $35,000. And this is all house money because we only spent $2,600 on the original position, and now we've taken 10 off the table. So this is like a completely free spread that we're playing with here. Now Viacom, we just talked about Viacom, and I said I'm as dumbfounded as to how cheap they are now as I was about HP last quarter. I can't do the math. I cannot come up with a logical way that I can do the math and look at the fundamentals of Viacom and figure out how they get to this price. Makes no sense. So if it makes no sense and I can't see any possible reason it should be below 30, why on earth wouldn't I buy it? So that's where we are. So now we're back into Viacom. And in Viacom, we're throwing out now the problem with Viacom is we have this spread. We already have this spread. It's not successful. It's down $5,000 or whatever. And it's 2023. So I started writing roll this, roll that, and I'm like, you're not rolling it. I said, just shut this position down. It didn't work. End of story. This position didn't work. We're done. So we shut this position down, take it off the table. And now we're just starting a brand new position. The brand new position is we're going to sell 10 $30 puts. We're going to buy 40 of the 25-40 spreads, and it's at 31 now, if I remember correctly. Oop, I didn't put the thing. Hey, what did I do? Well, I didn't put the chart for Viacom. That's weird. That can't be right. What? Are they at 35? I thought they were at 31. They are at 31. What the hell? Wait, oh, that must be from last week. Or last time we looked. Yeah, oh, it hadn't refreshed. I'm like, how can they be at 35? All right, so they're at 30.50, down 50 cents. They were at 31 this morning, still going down. You know, but this is the problem being a fundamental analyst. I don't give a shit what it says on the chart. I don't relate to charts. It's not a thing. It's like I don't care what the price is. I care what the value is, and the value and the price are not the same thing. Where was I? All right, so what we're doing is getting to the 25. So they're at 30. So these are $5 plus in the money. And we have 40 of them. So there's $20,000 in the money. It was 24,000 this morning. So we call it $20,000 in the money. And we're spending 14,000 on the spread. It makes no sense not to do that. I mean, unless you really think Viacom isn't worth $30, and since I'm sure it's worth $30, to the point where I'm fairly sure it's going to get bought. I'm fairly sure at this point it will get bought. You know, it's gotten too cheap. There's too much value there. To build a network like that would take you years and years. There's many corporations that would benefit from owning them. So, you know, it's at the point now as an M&A guy where I'd be talking to people about buying it up. Okay, so as I said here, we spent. Oh no, that's a no from the overall. Okay, but anyway, yeah, you look at this portfolio. So as this portfolio stands now with the changes above, we have $159,000 of upside potential on this portfolio, and it's still mostly cash. So I mean, I don't know what's not to like here. Now we're going to add, since we have so much cash, we're going to add 4 positions. But as you'll see, the 4 positions don't take up any cash. So, you know, we're adding 4 positions. Still going to have a ton of cash. What is a ton of cash going to do for us? It's flexibility. So if you think the market's going to go down and never come back, that's a different problem. We'd have to be more hedged. But since it's not what we think the market's going to go down and come back, then the only thing we would do with the cash is to improve the position and wait for the comeback, for the pullback, for the bounce. So I was thinking very hard about hedging this portfolio, but I just think the timing is wrong to be hedging it. So I said here, Intel is out trading for 2021, and we're adding that back in, of course, with and notice that these are conservative plays. Intel is at 50, and we are buying the 45-55 bull call spread, selling the $45 puts. Okay, and that's $1,000 in cash, and it's a $20,000 spread. And it's half in the money. So it's $10,000 in the money. We're spending $1,000 cash, and we're buying $10,000 worth of in the money position. And all it has to do is get to 55 again, where it basically hangs out normally. And if it gets back to 55, we're going to have $19,000 profit on that one. That's a cute one. And you know, look at the stocks I'm buying. I'm not looking for the momentum stocks. I don't give a crap about who's hot and what's this and what's that. I'm buying solid, steady companies that constantly make money, because it's a bad market, and that's the kind of those are the kind of stocks that you buy to go through a bad market. Is good, you know, solid performance. Altria. So Altria, and I always look at what they did last year. They made $4.5 billion last year. Last year was a terrible year. They made $4.5 billion. That makes them pretty recession-proof, right? Especially when you're buying the company for $80 billion. If they're $80 billion and they made $4.5 billion last year, that's a 20 times, it's not even 20 times earnings last year in a disaster. In a global disaster, they were trading at 20 times earnings. So, you know, so I'm not worried about anything terrible happening. Then people are going to keep smoking and keep doing whatever. Plus, if they legalize marijuana, the main reason we're in Philip Morris, if they legalize marijuana, these guys are going to take over that whole industry. Not just them, but I mean, you know, basically they're going to start selling cannabis cigarettes. You're going to go to 7-Eleven, you're going to get cannabis in a cigarette pack, and you get 20 joints for whatever, for $50 or whatever they end up charging. But people will do that the same way they stand there and stand in line to kill themselves now. They're going to stand in line for that. Because you haven't seen cannabis marketing. You know, you're going to see the same as cigarette marketing. You're going to see cannabis marketing. You're going to see branding. You're going to see all this stuff suddenly come out for marijuana products. So eventually that's going to happen. And these guys they're already positioned for it because they already own, which one is it? I forget now. Well, they already own one of the marijuana manufacturers. They bought Juul. That's been a big failure, but they still own all the ability to make all the vaping products and so on and so forth. I mean, it's been a terrible thing for them, a bad write-off and all that. And that's also, though, that's still impressive because this $4.5 billion included them taking massive losses on Juul. And that's over. So going forward, they're not going to lose another $12 billion on something else, hopefully. I think they learned their lesson. So stupidly cheap. Walgreens is another one that I had to scratch my head over because I do not get it. I'm sorry. Where's my chart? There you go. I mean, I understand the panic right now because people are like, oh my God, they're going to be closed down again. And you know, if you can't go to Walgreens, then they can't make money, right? So last year, they still did the $121 billion in sales, even though they were closed, which was really interesting. But they didn't make any money. They only made $450 million. But still, they didn't lose money. They just didn't make any. This year is 2021. So this year is 2021, and they're making $2.5 billion. Okay, they're not quite 100% recovered, but they're making $2.5 billion this year. Next year, $4.2 billion. Next year, 21 is done. 21 is over. They have their fiscal year is done. So they're into 2022 now. They're on track to make $4.2 billion. Next year they'll make $4.4 billion. And you can buy the whole company for less than $40 billion. You know, when you're analyzing the company fully, you're going to look at their debt structures, you're going to look at their balance sheet and their cash flow and things like that. There's more stuff to look at, but as a quick look at a company, it's like, how much money are they making for the $38 billion you're going to buy the company for? Think about buying the whole company. If I'm going to buy this company for $38 billion, what are they going to do with it? Well, they're going to give me 10% back on my money. And they're growing. And sales are growing at a decent clip. And they've shown that they're capable of making a much better total margin on sales. Why? They absorbed Rite Aid. They've been cutting stores and rejiggering, and they're in the middle of a rollout strategy. And also, what's not in here is vaccine sales. The forecast for vaccine sales isn't even in these numbers. And especially nothing to do with Omicron, nothing to do with another set of doses after this. So people are going to keep getting vaccinated. You know, you're going to get your vaccines, and you know, it could be CVS, it could be Walgreens, but you're going to go get your vaccines, and you're going to go get your vaccine at your pharmacies. People are getting the supermarkets too, but there's going to be pharmacies and supermarkets mostly. All these government centers we went to get the first batches of vaccines were based on an emergency. There's no longer that problem, and they're now doing it in these stores. So, you know, so you go to Walgreens for this stuff, you're sending all these people into Walgreens a couple of times a year to get vaccines and booster shots. And that's going to go on at least into 2022, probably 2023, maybe for the rest of our lives. You're making these things much more important part of our daily lives, these pharmacies. And I think that's going to be a very big change. So we'll see. Also, by the way, though, Walgreens is turning themselves more into, you know, if you go to Walgreens, you see they turn themselves more into like a 7-Eleven kind of thing. They got all this different stuff, and it's getting more and more of a store, a general store. When you go into Boots, people go into Boots for everything in Europe. I mean, the what they call the chemists, the drugstores there, the pharmacy plays a very, very small part of what it is, and people just go there for everything. A lot more things like daily use stuff, anything to do with toiletries, cosmetics. They're very, very big on that kind of stuff in Europe. It's a whole different environment when you go to these stores. And they're kind of moving in that direction, but slowly. They got to revamp thousands of stores. It's going to take quite a long time for them to fully get on board and modernize and all that. But meanwhile, they're making great money now, and they're going to keep making great money, and they're going to expand in the future. So I don't see any reason not to be involved in them. doesn't seem smart not to be in it. Where are we? That's why we're in Walgreens, and this trade is net 34.50, and it's not shoot. So they're at 45 bucks now. And how are we playing it? We're playing the 40, 52, 50 spread. So they're $5 in the money. All right. So they're 5 times 15 is they're $7,500 in the money on an $18,000 spread, and we're spending $34.50 for the spread. This is not, I mean, why would we not do that? You have to hate the stock not to want to do this kind of stuff. And I mentioned, because they're so weak, because they're looking so terrible on the chart, I'm a little hesitant to overcommit on the put side. So we're only selling 5 puts. It's only because they just keep going down. No matter, you know, it doesn't seem to matter what the price is. They keep going lower from there. So I'm being a little bit careful, and you see that in all these. In fact, I'm being very careful on the amount of puts. We're only committing to small amounts, 500, like that. And again, it's also because I think the market could go much lower, and I want to be able to roll to 2025s and 2026s when the time comes, if we stay low for a while. And then boom, the trade of the year, and I got to stop now. Gone much longer than I thought. So the trade of the year is IBM. IBM again, it's another one, 10 times earnings. I think that the Red Hat acquisition stretched out a little longer than they thought. But IBM is the stock of the future. For one thing, IBM is they've got the cloud computing, they've got the I forget the word, quantum. Thank you, quantum computing. They got cloud computing, they got quantum computing that they're leading the world in, and of course they have the artificial intelligence, the Watson stuff, you know, which got quieter, but it's still becoming a bigger and bigger division for them. And the Red Hat is all the Linux stuff and the server-based stuff that goes in with the cloud, and that's going to be able to grow. See, Linux is free, and it has a huge customer base. And what IBM will be doing with Red Hat is transitioning that free customer base. When those companies grow out of Linux or grow up in that environment, they'll begin using IBM services, and that's the gateway drug to getting into IBM cloud structures and so on and so forth. So it's a freaking great strategy. I was really thrilled when they bought Red Hat. It's taken longer than I wanted to execute, but they were our stock of the year in 2018 because of that. You know, and that's why they were our stock of the year for 2018. Is I love the Red Hat strategy. We made money then. We made money last year in this portfolio. We did, and we got out of it, and now we're going to make money again because it got cheap again. Every time they sell IBM, every time they want to sell me IBM for $115, I'm going to buy it. Every time IBM goes to $150, I'm going to sell it. That's the range, 115 to 150. Whenever it's at 115, I want to buy it. This is one of those times. So it just so happens that we have the opportunity to do the trade of the year when the IBM is at 115. And what's our trade? For the trade of the year, I want to be as certain as I can that we're going to make our 300%. So I said, well, look at this. I mean, when you look at the numbers, the 100 puts at 1250, the 100 calls at 2250, and the 115 calls at 15. So that's net 2,500 on a $30,000 spread. And that brings us to our last thing, which is how do you get into these things? Oh shit! Look at that. Things just getting worse and worse, right? As we thought. So, you know, IBM's jiggering up and down. You know, so when you're buying these things, don't be in such a hurry. I see you guys jumping all over stuff, and it gets me really ticked off. You know, you want to buy the 100 calls, and you see this is what happens. And whenever I announce the trade, oh well. You know, you watch your bid ask, but it was lower before, obviously, and they've gone up 50. They only gone up 50 cents today. It's about the net of the spread. But if the momentum of the trade is up, so the 115s. Okay, so the 115s are 1450, 1430, 1540, and the 100s have gone to 23, 23, 25, 25, 40. So if you're going to buy them, you want to bid like $24 for the 100s. And ask for, let's say, $15.50 for the 115s. So you're on the low end of the range from the ones you're buying, and the high end of the range on the ones you're selling, and you want to just do a few of them. So, you know, just a small amount first, but keep in mind you want to be bullish. So, you know, if you sell the 115s first and you get $15.50, then you say, oh, I better hurry up and cover and buy the 100. So you don't leave too long on the 100s. You have to watch the momentum, which way it's going. But if you fill your calls first and you pay $24.50, and you wanted to have a $6 spread, then you I think it was a $5 spread here. But then you say, well, then you do the math and you say, okay, well, I got this for $24.50, therefore I want to sell the calls for $19.50. And so you wait. You just offer $19.50 and you wait for it to come back. So I'm sorry, it was $7.50. So it was $7.50, not $5. Because you're buying the 100 calls at $22.50. So now they're $24.50, and that means you want to get $17.50 for these. If you know whichever one you fill first. But if the math doesn't work, you don't do it. That's all, but you scale into it. You're going to buy 20 eventually, so just try to get 2 at a time filled at the spread that you want. And obviously, since we're bullish, you want to err on the side of being bullish. You don't want to err on the side of being bearish. You want to err on the side of being bullish. You generally would like more longs than shorts, and otherwise, we just wait until the thing fills up. And that's true for any trade, okay? It's like if you're bullish on a trade, you start by buying the cheap calls. So if you can't get your price selling long, if you can't sell the short calls for a good price, then you must be able to buy the long calls for a good price. So the ones you want One side or the other has to fill. It can't be that you can't get either side. That doesn't make any sense, right? At some point, you're going to get one side or the other. Once you get one good price, then you already know that you're in the top of the range, and you can wait a bit for the other one to come down. But you have to think about which way you want to balance. You don't want to leave yourself in balance to the bearish side. So in other words, you don't want to sell short calls and not cover them for a long period of time, because that wasn't your bet at all. You wanted IBM to go up, not down. But it all starts by, am I getting my prices? So you should offer a good price for the puts, a good price for the calls, and a good price for the short calls, and wait and see what fills first. And I mean a couple at a time, not all of them. And then you see what fills first. Then you say, okay, I got that, so now I need this. And at the same time, you can offer. So in other words, if I offered, where's this thing? So if I offered $24.50 for the hundreds, and I asked for $17.50 for the 115s, okay? Obviously, I got a better chance right now filling the hundreds than the 115s. All right. If the 115s filled first, though, and I got my $17.50. So in other words, I'm offering my spread. If these filled first and I get $17.50 because this never came down to $24.50, then I know I have these short at $17.50. All right. Then I'm going to buy. Then I'm going to make an offer here. I'm still going to stick to $24.50, but I'm not going to wait on this. But then I'm going to look at, maybe I want to move up to the 105s, and I start thinking, okay, maybe I want to get that for a better price, because these are obviously going to be well below these. The spread here is 20-20-80, which is why, by the way, 24.50 doesn't make any sense here. If the 105s are 20.40, 20.40, 20.50, how could the 100s be 24.50? It doesn't make any sense. It wouldn't be $4 more. So this pricing is messed up, and that's just somebody's offering too much money for this one. But then you work it out. So let's say you're at $17.50 here, but then you fill, then let's say you fill these for, let's say you end up filling these for $26 because you get nervous and these are 17. Now your spread is 9, but now you say, well, wait a minute, what I really need those things to be, I really need the short calls to be, if you spend 26, you would need the short calls to be 1950. 1950, correct? Nope. 26. 1850. Sorry, 1850. So you sold the first set for $17.50. You need them to be $18.50. So what do? You offer to sell more for $19.50, and that would average you with the $18.50 that you need. That's all. You just keep doing the math on it and making sure it works out. And at the same time, obviously, you offer less money for the long calls, and if you get more long calls, that's going to bring your average down and improve your spread anyway. That's all it is. You just got to fill and fill and fill and fill, and just keep moving the goalposts until you get what you want. But if you do it right, you can average into almost anything that way, and it doesn't matter if it takes off, as long as you remember, I'm bullish on IBM. So if I'm going to have an imbalance, my imbalance should be a couple of extra longs, not a couple of extra shorts. All right. That's it. I'm out of voice. Let's see. All right. Tom says U.S. confirms first case of new virus. Well, I mean, it's bound to happen, so I wouldn't be shocked about that. Although I've had them, except the markets are probably like reacting to it. Cake, looking at selling 2024 40 puts and buying the 2024. Would you sell the short calls right away or wait? Let's see where Cake is at the moment. I do like Cake a lot. Not there. Oof, wow. Yeah, okay, so I'd wait. Obviously, I would wait because I think this is a silly low price for them. If we look at a longer term. Oof, man. Okay, so at a weekly chart though, they're only back to where they were, in 2019. and ignore, if you ignore that and ignore this, so stupidly low, stupidly high, back to about where they should be. They're a decent price here. This is the same decent price they usually are. So yeah, I would call this their channel. I would call the channels more like here, like 50 to 35 is more their channel. So down around here, I'd certainly buy it. It's what I was just saying about the other one. You buy it and you wait. Say, I want to be more bullish, but don't buy. If you're going to buy 10 long, you don't need to buy 10 long. Buy 5 long, and then when you get a good price of the short puts and have a really great cheap spread, then you buy another 5 long and work your way into it. Don't go crazy and buy all the longs right now, because then you're making a directional bet, which wasn't the point, right? Cool. Let's look at. Now, Cheesecake Factory at this level, it's only $2 billion, which is, I think, really a good price. They're not, they're not blowout. So for $2 billion, you got $3 billion in sales. They're making $160 million. All right, so you're still talking, your PE is not, it's 12, 13, 14, whatever the hell it is. This is not a bad ratio for a growing company. It's clearly a growing company. I'm not sure what the step back was here in 2019, but bottom line is, they generally were growing. They came back a bit here, and obviously 2020 you can't count. That's actually remarkable for 2020. They lost money, but not much. So they lost some money, even keeping all these restaurants open, which is a hell of a cost. Now this year, sales are popping. So basically this sort of interrupted their growth, but their growth is now right back on track. They're up to 3 billion, 3.3 billion. That's the thing. See, these averages, they're all screwed up. Everybody, if you look at this and you don't understand why this happened, you think everything's not growing well. These guys are growing 10% a year very nicely. They're way, way better than they look, and profits are growing nicely too. So had this not happened, they'd be in great shape. Now, of course, they certainly ate up a lot of cash, and that's going to impact their earnings going forward, but eventually they'll pay this all back, and then they're going to have a spectacular shot of earnings growth. So as a long-term 5-year, 10-year investor, this is a fantastic opportunity. But again, only assuming that they don't get whacked with COVID again. And that's where this panic is coming from, okay? People are freaking out. What if they close all the restaurants again? What if we never have restaurants again? What if we never eat out again? Blah, 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 blah. There are ways to redesign restaurants with big, with air filters and things like that would circulate the air to a much larger extent. Don't forget the reason they tell you not to eat indoors is circulation, right? Outdoors, lots of air, lots of circulation. Indoors, there's no circulation. Therefore, the virus just sits around and floats and whatever. That's bad. If you had air exchangers in restaurants that would basically constantly be sucking out the air, and filtered fresh air would come in with no viruses in it, and they had other health measures in place, including those things that, like ultraviolet things that clean the air and so on and so forth, you would actually have restaurants that are fairly safe to eat in. Probably you could argue that they would be safer than your kitchen. So it's a question of they haven't gotten around to spending the money yet to clean these places. But they know they can do it. It's a doable thing. They just haven't, it just hasn't been the need. But believe me, versus extinction, it'll happen. And I actually prefer investing in Cheesecake Factory, which has, a couple of hundred restaurants or whatever the number is, because they have a couple of hundred locations, and they are upscale, and they can afford to make the kind of changes that would be required to run a restaurant, because they may end up, if this virus continues, they're going to have to certify restaurants as safe to eat it. They'll start giving directives and saying, look, this is what you need to do to have a certification where you're a clean restaurant. And people are going to start doing it. Some restaurants will do it, and some restaurants will be like, I can't afford that. It's just going to become part of the cost of running a restaurant. And maybe food will go up, and maybe that'll cause more inflation, and we'll all pay more for the food. But you know what? Even if you needed $1 million air exchanger in a restaurant, it costs way more than that to open these places. It would maybe bump the cost of it would maybe bump up the total cost of opening a restaurant up by 5%. on a big place like that. Cheesecake Factory is a $20 million build. So if you're bumping up the cost, for McDonald's, which is a $1 million, I'm sorry, not a million, a McDonald's restaurant is maybe a $3-4 million build to build an actual franchise location, right? So if you're going to bump that up by $1 million, that's pretty significant. It's 20-25% of the cost of the building is going to be your air exchanger. But if you do it on a $20 million giant Cheesecake Factory thing, which has way more revenue per location and so on and so forth, you're going to add 5%, 10% to the cost. So you put 5-10% more on the menu in the story. It'll get paid for. So yes, I like it here, and I think down the road, I think the cost of this money is being reflected here, and when this money is paid back over the course of 5 or 10 years, you will see massive bump ups in the earnings, and you want to be there when it happens. But to do that, you got to ride it out with all the impatient people, because these people just don't have the patience to wait for the turnaround. They don't have the patience to wait for this loan to be paid off. They don't understand that the reason you make 119 million here is because you paid 50 million of this money back. If you didn't pay 50 million of the money back, you'd have more money. That's what happens. You borrow money, you impact your earnings in the future. That's why people don't like to borrow too much money. But once you do, you got to look and say, okay, well, that's a done deal. Do we have to spend it again? That's the question. Will we have to spend this every year? Probably not. And if you don't have to spend it every year, then it's an improvement. Now imagine if they have 200 restaurants and they did spend $200 million on air exchanges one time, yet next time there's a crisis, they're the best place to eat. Everybody goes to Cheesecake Factory because they're certified clean for COVID. Then they'd be like the bright shining star in the sector. Why? Because they invested. So we'll see what happens. I think at a certain point you're going to hit herd immunity. Everybody's going to be vaccinated. You'll continue getting vaccinated against the strains, which in fact this is one of like the Walgreens bet is that you're going to continue to be vaccinated, just like the flu, except that unlike the flu, instead of 2/3 of the people getting a flu shot, I think you'll probably get a little bit better than 2/3 getting their COVID vaccines updated once people realize it does make a difference. And a couple of years experience will make people understand, yes, it makes a difference if you're vaccinated. People will get vaccinated, it'll become less of a risk, life goes more or less back to normal. You stop freaking out about strains, just like we have strains of every year they talk about the bird flu. They constantly remember the bird flu. They talk about all the time, new strain of the bird flu, new this, new that. And the regular flu too. They go, oh, terrible flu this year, blah, blah, blah. We totally ignore it. And yeah, 60,000 people die of the flu in the US every year. 60,000 people. Oh, okay. 600,000 people have died of COVID, but 60,000 people die of the regular flu. So you will have good COVID years and bad COVID years, just like we have good flu years and bad flu years. And some years 50,000 people will die, some years 100,000 people will die. But it's just going to be one of those things you live with. It's just one of the causes of death in America down the road. So people will stop panicking about it and get used to it. I mean, honestly, if small meteors knocked out cities once a quarter, how much would people really change their investing strategies and other strategies, right? What you would do is you would tend not to want to invest in somebody who's got all their eggs in one city in one basket. And and if you say, well, every quarter there's a meteor strike somewhere on Earth, and obviously 3/4 of the time it would go in the ocean, and 1/4 of the time it hit land, and other times it hits land, it would impact certain cities, and blah blah blah. It would all just become another calculation that you learn to live with. What are you going to do about it? You got to just live your life. Hope you don't get hit by a meteor. It's going to be the same thing. Eventually, everybody adapts to everything. It's really weird and funny thing about human existence, but that's how it works. All right. So, let's see. So 7 o'clock, I'm going to be on BNN in Canada on the Money Talk show, and we'll be talking basically about the same stuff about the Money Talk, about this portfolio and these trades. And that's it. And otherwise, I think we'll see what levels hold and how things do. But it's all about this line here. It's 2200 line is the most important line in the market right now. So we'll keep a very firm eye on that. All right, thanks for coming, everybody. Have a great day.